So Zach, where
All
are you?
right, I'm good. I'm just going to be doing back end stuff while you talk. I'm going to
Okay,
be checking on things.
somebody's super normal AI note taker. Zach, yes. Where are you? Where are you calling in from today?
I'm in Ohio,
Oh, okay. Where in Ohio?
Northeast Ohio, so near Akron.
Okay, all right.
I have family in Akron. That's awesome. In Turkey Foot Heights,
Very,
actually.
all right. All right. Yes, I'm just outside of DC, and Helena's in New York City.
Yes. But I grew up in northern Indiana with cousins in Akron.
All right, let's see. How are we doing? I don't know. I think
I
should we get I mean, we have there's like
think we should
maybe
get started.
yeah, I think we should get started as well, just in the interest of time. And all right. So you ready, Helena?
Yes.
All right. So hi, everybody joining us today. I'm Lisa Leach, and this is, drum
Helena
roll.
Fogarty. Hello.
We are the co-founders of Backable, where we focus on helping founders, particularly underrepresented founders, raise early stage capital. And the webinar that you're joining today is going to be a workshop around basically preparing yourself for the investor Q&A portion of the fundraising journey. So and I'm also going to be driving the deck, so a little bit more than about us. We just introduced ourselves, so just letting you know that both Helena and I are former founders. In fact, we founded a bunch of different companies, startups, so we have been along this path that you are on. We have launched worldwide products, we've led VC-backed startups, and we've done a bunch of things in the community as well, running a community for women founders in particular. Helena hosts 2 fundraising podcasts. Some of you might have seen those. We've advised hundreds of founders and raised millions of dollars along the way. And as I said, since the 2 of us are both ex-founders, we were given a bunch of advice, as many of you might have been given already. I went through Techstars, for example, as a founder, and we were given kind of a standard playbook of this is what you're supposed to do when it comes to fundraising. And after putting that playbook to work, we figured out that the rules of fundraising didn't really work for us like they might have worked for others. And so ultimately, we decided there had to be a different way, or that we needed to be able to take different advice. And so we decided to change those rules. And that's why ultimately we founded Backable. To bring
And
that.
for example, I've interviewed a lot of founders, including met with YC-backed founders. And what we found is if you are different from the prototypical kind of pattern match founder in any way, that pattern matching being 19-year-old white male Stanford dropout who lives in the Valley, you will have a different experience raising. And so I've spoken to YC-backed founders who do not match that pattern, and they've had to throw out the YC playbook in order to raise. So things like there's a lot of posturing out there where people are giving you broad advice, generally suited for that founder, that say, don't meet with VC associates, only meet with the partner. And many of you are going to have to follow a slightly different playbook depending on your specific situation. You're going to have a different experience in the meetings that you have than other founders. And so that's why we created Backable, and that's why we're here today.
All right, so let's just talk about quickly telling you what we do in general, and then we'll go into the agenda, what we're going to cover the rest of the day today. So what we do is Backable, other than webinars like this, is we provide raise services, like we said, for founders, early stage founders, but particularly the ones, as we said, that the standard playbook often doesn't speak to particularly well. What are raise services? That is everything from what should your raise strategy be? What sources of capital should you actually look for? And how do you plan to go and raise capital from those sources? We talk a lot about VC, but VC is not the only source of capital for many early stage startups. Then there is the prep and training. This is kind of the training of you to get ready to pitch, to get ready to answer questions, and also the prep, pitch deck, financial model, things of that sort. Then there's the raise itself. As the raise is going on, We also provide that program management and coaching. Why is that important? It's because this is probably, many founders frankly describe the fundraising process as one of the hardest and maybe even the worst professional experiences they've ever had in their lives. So it is so easy to stop before you reach the finish line. In fact, you desperately want to do that because it's no fun to get 99 people out of 100 telling you that they're not interested or they question your premises or something like that. And so we provide that support during the raise process to keep people going, and then ultimately at the very end, getting the checks in, closing the round, and any post-raise support like communicating with investors and things like that, and getting you set up for the next stage. And then last but not least, in terms of what do we mean by early stage, we mean pre-seed, seed, or Series A, raising from US sources. We do help on occasion companies that are domiciled outside the US, but their goal is to raise from US sources, and that's what we do. All right,
And
so
I
let's,
think I jumped in earlier, but again, we've just found that other, founders that are different from the standard founder need a different playbook, and we specialize in that to get you back to building, to raising efficiently, effectively, and getting back to building.
all right, so today, here's what we're going to do. Is we're going to talk to you about essentially two broad categories of questions that investors are going to ask. They're called prevention. This is sort of in the research around questioning, let's just say, but particularly fundraising. Prevention questions, which are the questions that are risk and downside oriented, and promotion questions that are the upside and opportunity oriented, and why it matters a lot, as it turns out, how well you answer those questions. We'll then share our framework. We call it the ABC framework of how to answer prevention questions, which are usually the ones that many are most worried about. How do you answer those risk and downside questions to your greatest advantage and increase investor conviction in terms of how you answer those particular questions? Then Helene and I will role play 3 common, or maybe 2, depending on time, common prevention questions that a lot of founders will get, and you'll see what is it like? The question I get asked, how do we answer it? And then we'll show how ABC actually works in practice. Then we're going to turn it over to you. It'll be your turn. And for the people who are super brave, you'll get to practice doing an answer to a prevention question of your choice. And then you will stop, we can analyze it, give you some practical feedback and things like that. And then at the very end, we're going to talk about how you can take from this, and perhaps if you're interested, we could work together further ultimately on how to essentially get ready for investor Q&A in general, because as you can imagine, this is just with all skills that you have to learn. It's not something that just comes honestly within a single hour. It's something that ideally does take a lot of practice, and that we have a program that we're going to talk to you at the very end about how to help you get that practice.
And just to recap, we are the only people that we've seen offering this kind of training. So both here for free, but also in our workshop. We don't see this kind of training happening anywhere else that's directed towards people who may be a little bit different from the prototypical founder.
All right. So let's talk a little then. Some of this is not going to be super new news for many of you, but just to say, if you are we call it not Chad. So this Chad is the 19-year-old Stanford dropout, basically. But if you're not Chad, then particularly venture capital VC funding is going to look like this. For, I don't know, last 30 years or so, 2% of venture capital funding has gone to all female founding teams, even less to all racially diverse, i.e. non-white founding teams. And the last stat, which is where there's a little bit of a bright spot, but teams with at least one female founder get 17% of capital. That number has actually increased a little in the last, certainly in the last 10 to 15 years. The other two, frankly, sadly, have not.
You want to call upstairs? Okay. Whatever you want.
Can you guys put yourselves on mute, or you're gonna mute people? Okay.
And mute people.
All right. So let's talk a little bit about, again, the 2 kinds of questions that I alluded to before. All right. The first type are the promotion questions. These are the questions about upside, about the potential. They invite you to dream and talk about the possibilities. A good example of that would be, how big can this get? Now let's go to the other side, which is prevention. These are the questions about the risk, the downside, the ones that make you feel, frankly, more defensive, usually when they are asked. A good example, again, is how are you going to defend against competitors? So now let's come back to the research here, which some of you may not know, which is it was a groundbreaking study done focusing on the TechCrunch New York pitch competition done in 2017, where essentially Columbia researchers who then published the results in Harvard Business Review, they looked at all of the people pitching, essentially, or invited to pitch at TechCrunch. And just by the way, TechCrunch already, we can assume, has already done a vetting process. They have determined that the business, that they're at a similar stage, it's worthy of being on their main stage. They can't take everybody. So let's just assume, for the sake of argument, that everything about the business is essentially ready for prime time, according to TechCrunch. It turns out that the type of questions that you get asked and the proportion of those questions actually is very different depending on who you are. And in this case, 2/3 of questions, for example, that male entrepreneurs got asked were of the promotion type. And, 1/3 of the prevention type. By the way, everybody's going to get some of both. And they're both types of questions are totally normal and in bounds. But as you'll see in a minute later, the proportion matters. So whereas 2/3 of the questions that male entrepreneurs get a promotion type, inviting you to dream and talk about upside, it is literally the exact opposite for females. So female entrepreneurs tended to get 2/3 downside and risk questions. And you say, okay, well, that might just be interesting. So, but like, why does it matter really? Well, as it turns out, those same researchers then followed the fundraising journeys of those companies. And what they found was pretty eye-opening. The first thing was that, on average, the entrepreneurs who were asked mostly the promotion questions, i.e. the men, they raised about 17 million. If, however, you were in the category of the entrepreneurs asked mostly prevention questions, you raised just over 2 million. That is a massive, massive difference. And even further, and we'll come back to this a little bit later, the next interesting thing about this, which is that while you cannot control, for example, the questions that investors ask you, you can control how you answer those questions, which is why we're here today. It turns out that entrepreneurs who got the prevention questions and who stayed in a prevention mindset, they were mostly focused on risk in their answers, they raised just only 560,000, but those who were adept at taking a prevention question and turning it around and flipping it into a promotion answer, got a risk question, but you answered it in an opportunity-focused way, they raised 8 million. So you can see here that the way you answer, it really, really matters, and in fact, it can matter to the tune of millions of dollars. All right, so the first thing, of course, is that you got to be able to spot the difference between a prevention and a promotion question. You'd think this would be easy. Sometimes it is, but sometimes you're like, I'm not really sure. Like, which way is this question going? So let's just try it out for the sake of argument. And for people, I want you to either, like, you can shout out, or probably better yet, put your answers in the chat real quick, and Helena will...
put your answers in the chat and I'll take a look.
All right, we're going to try out a couple questions. Okay, first question. What's your total addressable market? Is this prevention or promotion? All right, I'm going to give you like 10 seconds.
We got promotion, 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 promotion.
Everybody's
promotion.
on everybody's
saying promotion.
Okay,
yes.
Awesome. Let's find out. Correct. Yes. We will classify this as a promotion answer. Promotion question. So really inviting you to talk about, again, market possibilities, the size, and things like that. Frankly, it probably could cut both ways, depending, because in some ways that people could be saying, I think your market's too small. So how big is it really? That could end up actually being prevention. But let's say on average, this is more of a promotion type question where you get to talk about, the long term and the size of the opportunity. All right, let's take another one. Have you considered raising when you have more traction? Boy, how many times I got asked this question.
Prevention, prevention, prevention.
All right.
We might have made these too easy.
I know. I should have made it tougher. Yes, indeed, prevention. But that is also basically anything that kind of is questioning your premise or your reason for living. This is a prevention question, and you'll probably immediately start feeling defensive and the tightening of the stomach. All right.
Leah says she's gotten the "we don't think your TAM supports VC investment." Yeah, that's
There we
pretty
go.
common.
There we
Yeah.
go. Yeah,
Mhm.
there we go. That how to turn a promotion question into prevention.
Yeah.
VCs are good at that. All right. So last question. How many monthly active users do you have? Is this a prevention question or a promotion question?
Prevention, promotion, prevention. It could be both.
All right. So we got a mix of answers. I think mostly we see this as prevention. And the reason that this is prevention is that, as with most questions, there's a statement underlying it, which is this real? Do you really have anybody using this thing? That is usually what is behind a question like that, if it has to get asked. So,
And again, these questions, everyone gets some of these questions. They're not out of line.
yeah.
People want to know where you are in your process, but the key is to how to address them.
Yeah. All right. So now, Helena, do you want to take this one? So this is where, just kind of
Yep.
going through psychology of how you answer, and again, back to why it's important to
Yeah.
do the
So
opposite in some cases.
it's very common to mirror in your response to the question. So if you get a prevention question, you respond with a prevention answer. You get a promotion question, it's very normal to respond with a promotion answer. However, psychology shows that the key is to switching that, right, for us. And that's not so easy. So we need to practice that and flip the script. Basically taking a prevention question and turning it into promotion answer. We have seen that in a successful fundraise, you want to spend 70 to 80% of your time speaking focused on the promotion, the big vision. And so it's your job as a founder, regardless of what type of founder you are, to make sure that happens. And we're going to teach you how.
And just to remind you, the same figures we showed earlier, this is why this matters. And this is why, as if any of you saw our, even the title of our webinar is, many founders will spend upwards of 100 hours perfecting that pitch deck. And we are here to say the pitch deck, there is nothing that perfect slides will do for you that will not be completely undercut by having spent almost no time preparing to answer these questions. So if honestly, the right ratio is probably 10 to 20 hours on a pitch deck, and take the rest of the 80 and spend it constantly testing yourself and doing it in front of other people. How am I going to answer these questions in a way that puts my business and myself at the best advantage? And the numbers don't lie. If you want to raise 8 million, do it our way. If you want to raise $500,000, do it the other way, the way that human psychology is probably going to lead you to answer it. So,
and the worst thing is when you think you've nailed your pitch and you're feeling really good and someone asks you a question and you just kind of forget you even exist.
yeah.
Right. So practicing this stuff, having answers in bullet point ready to go is going to serve you so much. 563,000 might seem like a lot to some of you, but 8 million is a lot more. Be a lot nicer to have that outcome.
All right, let's now do a little bit of, let's talk about the framework. All right, so this is the framework that we have for prevention, the risk questions. It's nice and easy, ABC. So the formula is the following. And to start with, for some of you, this may come easily. For others, this is going to feel very, very bizarre, but encourage you to try this and keep working at it. And the framework is the following. The first of all is you do acknowledge briefly the question that has been asked. You don't want to completely evade it, because then again, the whole thing seems like you're evading, like you're trying to hide. Don't hide it. So you're going to acknowledge, but you're going to stay there briefly, because you don't want to stay in that risk place. You want to turn it around to spend time in that opportunity place. So the next thing is, okay, how do I bridge from the concern that the investor has just raised into what I'm going to do is spend the bulk of my time now on the opportunity. And then C is you want to change the conversation from risk to opportunity. So A, acknowledge, B, bridge, C, change the conversation.
And acknowledging is super important because, again, you don't want to evade the question. And by actually addressing the question, albeit briefly, you're allowing your investor to like relax a little bit. Whereas they're just going to get really annoyed and write you off if you're evading the question. Like, this person doesn't know what they're talking about. However, you say, answer the question, and then here's the upside.
All right. So before we dive in, because I think at this point, Helena and I are going to do some role playing so you can actually watch what this feels like in practice. But we probably should have done it earlier. But are there any questions or any comments that anybody wants to make first before we go into the role playing, and then obviously letting you do the practice yourselves? No raise hands. Okay. All right, let's move on then. Okay. So here's a good one, a common question. So Helena's going to be the investor in this particular case. I'm going to be the founder. And just to set the scene here, the company that I'm going to be talking about is actually the company that I started, my startup from a while back. And it is in the fintech space. It's one of those things that's kind of a two-sided market, serving both financial professionals like financial advisors and attorneys and things like that. And then on the other side, families. Okay. So that's the scene. Helena, off you go.
Liesl, thank you so much for telling me about your company. This seems like a really big vision. What's your beachhead?
Yeah, at first blush, it might seem like something that is, really big and ambitious. But for us, we're choosing to focus by launching in a few specific cities in this early phase. And in fact, the dual-sided approach, professionals and families, by focusing on them both at the same time, it's actually our greatest strength, as it creates a powerful local network effect that accelerates our growth. And that's actually what we're seeing in our early pilot cities. So here's how it works. Each new financial professional that we onboard brings hundreds of families that they serve onto our platform. And in turn, each family that joins our platform usually has relationships with more than one financial professional. So they invite other financial professionals they work with to join as well. So in Peoria, where we've been active for about 15 months, we're already seeing this flywheel effect. We had 180 professionals join us over the course of that time, and they brought on 16,000 households. And those households, in turn, have brought us another 45 financial professionals. So what this is doing is it's creating a compounding advantage where both sides of our marketplace grow simultaneously. And this, we believe, is the thing that is establishing our moat, especially against our competitors, most of whom focus on one side of the market or the other. Okay, so let's pause.
Excellent. I can really see your vision here.
Excellent. You're going to write that check? Great.
Yes. Wiring right now.
Yes. All right. All right.
If only you were that lucky.
So let's go back and just break it down a bit, bit by bit. And then maybe we could also try, I could even try like another answer to it. But if we had to break it down, Helena, like, tell us about little b, like, how might this question show up? Because they don't always ask, what's your beachhead? But there are a number of different ways that this question can.
Yeah. So I don't know if you all remember going to school early on math questions where there was like a hidden question. That's one of the things you have to find out when you get these questions, right? Not only designating are they prevention or promotion, but what else are they? What are these questions? So other forms this question can take would be, your business seems too complicated. Have you considered starting small or improving the concept with just a few clients first? Or this sounds like 3 or 4 businesses at once. Why not just focus on one? Or even, aren't you taking on too much risk trying to build both A and B simultaneously? And underneath these questions, what they're really asking or testing is, do you really have the chops and the team to manage a complex business like this? Are you disciplined enough to focus and stay on plan? And then lastly, could you be just naive and not know how complex the business is and what you're attempting to do?
Yeah,
so those are the questions you really need to answer in your response.
And some of the things that happen very often is that when somebody pushes back on something like that, and your perception is, oh, they know more, they're more experienced. You know,
Mhm.
it's often the case with VCs, you know, they sound like all that, you know, that kind of thing sometimes. Maybe your first like reaction is, ooh, they might be right. Maybe I should rethink. Did I do it wrong? That happens all the time. And so we're
All
saying
the time.
be ready for that reaction in yourself, but stop yourself before you say anything that confirms that that's maybe how you're feeling. So the whole thing is, yes, you may react that way internally, but externally, what you're going to do is don't scale back, don't abandon, and don't immediately begin to doubt and question the strategy that you have come up with and you are moving forward with. All right. Um, so just to unpack the answer that I gave to show A, B, C at work, very specifically, the A, of course, was my, yeah, at first blush, it might sound that way. So I was just doing a quick acknowledgement and sort of, you know, respecting and yes, get that. Totally, people can see it that way. The next part is the bridge, which is I focused on saying we're launching in specific cities to say that I understand the concept of focus. We're focusing by launching in a few geographic areas, let's say, and not nationwide to begin with. So that was one thing. The second thing is I specifically addressed this thing that Helena had alluded to was a weakness, meaning my business is too complicated. Why are you doing two things at once? And said, in fact, it's not a weakness, it's actually our greatest strength. And let me tell you why it's our greatest strength. And that then gave me the lead in to the changing of the conversation. Then I used that to talk about how the business works quickly. And if you can, I gave specific numbers. I gave data, I gave numbers that backed up my answer because we'd been in market for a little while and I had some numbers to share. So here's the thing. What if you're pre-seed, pre-product, you know revenue, and you're just building your MVP? You're still going to get this question. So how do you answer
Mhm.
that when you don't have all these numbers? Well, the way to answer it then is probably still, yeah, it might appear that way. Same acknowledgement. Then B, you would say, in fact, we believe that by essentially serving both sides of this market at once, this actually is going to become our greatest strength. And
Mhm.
here's why. Because when professionals join our platform, families will follow. When families join, they will invite other professionals. And what that does is create a massively powerful flywheel effect that will become the core acquisition and growth engine of this company. And that growth engine, which will mean that effectively our network becomes our sales force in some way, also brings down our acquisition costs well below those of competitors. It increases our retention rate well above those of competitors, and that's a thing that's going to establish a moat versus other companies in this space who tend to focus on one side of the market or the other. So I've used essentially the theory, our plan, and I've shown that there's thought that's gone into it, that I understand the dynamics, and that I'm thinking about it in a strategic way, even if it's right now hypothetical. Um, so that's a way to answer it if you're, if you're very, very early stage and you don't have anything in market yet. So let me stop there and just say, any thoughts, questions? Has anybody gotten a question like this?
Anyone? Bueller?
Yes.
Well, Becca
Yeah,
says he
hi
has a good
there.
answer. And
Hi. Can
Marta
you?
says, yes, she asked herself this question. Sandra, did you want to speak?
Yeah, sorry, I wasn't
Okay.
sure whether you could hear me. Yes, we've had a question like that. What's the beachhead?
And have
It wasn't so much a direct question as much of a meandering of conversation where actually we presented it already as the beachhead, and then it was like, okay, yeah, I really like your beachhead. So, okay. But
yeah,
yes, it kind of came up.
that's good. That's good. I mean,
Yeah.
so I certainly have to say I certainly got this question. In fact, I literally got this exact question because the whole for the business that as I described, it was in fact a two-sided marketplace, and we constantly got, why aren't you doing one thing or the other? Why are you doing two things at
Mhm.
once and things like that, you know? So yeah. How Santa, what was your what way did you address it? Like what was the beachhead? Just out of curiosity.
Yeah, sure. But it was still at the stage where we were finding our feet in terms of our proposition. And I think in reality, where we are now is still a little bit in both sort of markets because they're very closely linked. So what we do is we have a document fraud assessment tool. And at the same time, so we verify the trustworthiness of documents, the authenticity. But at the same time, we look at, okay, so once you have verified that, now that needs to be governed. It needs to be protected and it needs to be secured for sharing potentially with litigation as an outcome.
Yeah.
So we're looking at insurance claims fraud, as well as sort of the legal side of things. So we're a little bit in both.
Yeah.
Because it does serve as both ends of the proposition.
Yeah.
To be in those two markets. And you talked about a flywheel, and that's very much how we see that working and coming together as well. So I think when we started speaking with the investor, it was very much focused on legal. And we felt that that was actually too narrow for us because there is no urgency in legal cases and detection of fraud there in terms of a financial urgency. Whereas in claims fraud, there is a very clear financial urgency.
Yeah. Yeah.
So we shifted from actually that's where we need to front our efforts, and then the rest will follow after.
Yeah, that's great.
I hope that's making sense.
Yeah, yeah. No, it actually makes total sense. Helena and I are kind of smiling because we work with somebody today working on claims, building a claims platform. So that's very interesting. And then for me, my former business was in fact relating to legal documents, and one of the things that which we had to do was to validate the authenticity of legal documents and the identity of the people creating them and things like that. So anyway, but all right, well, thanks for that. Let's move on to the next question so that you can see this in action for a different question.
And before we go to this question, when you hear this question, I want people to comment in the chat if this makes you want to throw up, if this question makes you want to throw up. Okay.
All right. Okay. Wait, did I go backwards or do I go forward? Hold on. Oh, here we go. Okay. All right. Now I get investor, and I get to put Helena on. All right. So Helena, this all sounds fantastic, but how long is your runway? How many months of capital do you have left?
So again, I want to know if this makes anyone want to throw up before I answer, but now I'll get started. Liesl, thanks for asking. Now we have just under 6 months of runway at our current run rate, and our revenue is actually covering our costs. What we're doing right now in terms of raising money is we've mapped certain levers that are driving our growth, and we're raising money to apply the investment money to drive our growth. So our revenue has grown 30% quarter over quarter. We're seeing strong user activation. We have new fiduciary referrals in our early cohorts, and this raise is all about accelerating momentum. We've had a couple days, a couple $50,000 days, which is awesome. And we want to make that more common, right? So we want to expand into new local markets, investing in sales, and hit our next major milestone of $1 million ARR by end of year.
All right.
Last year, we made targeted cuts and reallocated spend that extended our runway by 4 months and also led to our highest quarter of growth. So we're really doing this to double down on the things that we see are working. And this isn't out of necessity. We could keep going the way we are, but we just want to grow this as big as possible.
All right, so let's take a pause. How many people have gotten some form of this question, which could be, by the way, what's your burn rate? How are you going to avoid spending too much? Or aren't you spending too much? Shouldn't you be spending less? Those kinds of things. So has this come up for anybody yet?
We have instant headache, throw up sign. Marcia doesn't get any problem with this question. Zach says this is a prevention question. Yes. Sanda says, is this an easier question to ask when you're fully bootstrapped, or answer when you're fully bootstrapped? Probably. Lydia says, yes. I know even now, not in an investment backed startup, like this question makes my stomach drop, because I remember this question. I remember that there are times when you're running your startup as a bootstrap startup while you're trying to raise, and it can be tight. But there are ways to answer this that can address the concern, and then show them how strategic you're being in growing this company and why now is the right time to invest.
Mhm. All right.
Liesl, do you want to go through how the other forms the question might take?
Yeah, I think, like just as we said, somebody might say that, like I said, aren't you spending too much money? So this is another form of like, A, do you know how to manage money? So this is some of like, what's the statement underlying? Do you know really how to manage money and how to handle your capital? Are your cash flows really predictable? And how much can I trust that? And again, what's your monthly burn rate, something like that. And so in the end, like there's really probably only a few things that people are asking. First of all, it's like, do you have a grasp on your business? Do you even know? Like, that kind of thing. So that's one set of, fundamental doubts, I suppose. The other one is, are you really desperate? Am I just going to be throwing good money after bad or whatever? And I'm, that you're just basically taking this capital to like shore up gaps, versus you're taking this capital to make a strategic investment in the future and growth, and I need to have confidence in that, that kind of thing. So in the end, that you never, even if you are desperate, because let's be honest, many startups are often desperate. So that is true. But you have to, so if you are in that situation, don't feel bad, because 97% of other startups are in the exact same situation right at this minute, basically. But you cannot answer it in that way. You obviously have to have sort of like channel the ice in your veins and flip to the kind of answers that we just gave, which is acknowledge quickly, give an answer if there is, if you have one 6 months right now, then talking about, however, how you're aligning the spend, or you're aligning the funds that you're raising currently to address very specific and to achieve very specific, specific as you can get them, strategic milestones to amplify growth, not to shore up risk or to fill in gaps. So any thoughts or questions about this one? How have other people answered this in the past?
We have two questions. Marcia said, is runway about how much you currently have, or is it how long the money you're asking for will last? And then we have Zach, who says, do they want you to have a long runway or a short?
Well, let's see. Let's take Zach's question first, if we could, because for the most part, no investor wants to hear I'm desperate, or if they do, they're sharks and they're about to take you to the cleaners if they can do it, kind of thing. So no investor really wants to feel that you are so desperate that you are going to keel over in a couple of weeks, unless money comes in. So in general, they prefer longer runways to shorter runways, but runways are what they are. And so in the end, even if your runway is reasonably short, you're going to have to still pivot to, but we're raising now to do X, Y, Z, and here's the evidence that we know what to do, and that we have a very specific concept of what we're going to do with this money and how that money is going to lead to revenue and growth. And that's the key thing. Helena, do you have any thoughts on that one?
Yeah, so there's discernment in here, but right when you are speaking to investors, you ideally would have 6 months of runway or more when you start conversations. You don't want to have more than 24 months of runway in the bank unless you've just raised and closed that money, right? So if you're raising from VCs, there tends to be a cycle where you raise, you get 18 to 24 months of runway, and then you start raising a year later to close it in 6 months, et cetera. So you always have a certain amount of money in the bank. You're never down to zero. So there's a range, right? 6 months plus, if possible. And we know that's not always possible. We've been founders too. We are founders. But you don't want to have, 10 years of runway or 5 years of runway, because that seems to be just hoarding money that you could use for growth.
All right, now to Marcia's question, which was, can we just repeat the question?
Yeah, is runway about how much you currently have or how long it will last?
It's really about how long it will last, because so that's why the burn rate question is sort of another way of asking this, which is at your month, basically they're saying, and this is sort of the term of art in some ways, especially for among VCs, which is if you take the money that you have in the bank and then you say, I spend this amount per month on average, I just literally, how many months do I have at this current rate before essentially I would run out of money. All right. So that's really how to think about it. What they're not asking is, yet anyway, is if you get the investment you're seeking, then how long do you have? That's different. That would be, something like, how long will your run, how many months of runway are you looking for with this raise? And then you'd have a specific answer for that. But usually this is about how much money do you have in the bank, which you're not going to tell them, but you're just going to tell them how many months on will that money last were you to get essentially no other investment.
So we have a couple questions regarding runway and the stage, right? Does runway needs change based on stage? And I would say no, runway needs don't generally change based on stage. I've also worked with Series A and Series B clients, and what, like the day before they get that wire closing that round, it can be tight, right? But when you go out to start talking to investors, you want to have money in the bank so that they believe that they're either not paying down debt that you've already incurred and that the money will be used for growth. If you're talking about pre-seed and you're bootstrapping or you're just bootstrapping, there needs to be, we don't want you to go to talk to VCs without any money. And there are some tactics that you can do around that. There's money that can be raised from angels, from friends and family. There can be other ways to have money in the bank to answer that question. But it's all very specific. You just don't want to, in general, you don't want to show up to an investor meeting being like, I couldn't pay for lunch today, right? Like, even though that can sometimes be the reality, you need to portray that you are going to be able to survive. This company is going to survive regardless of the outcome of the meeting, that you're in conversations with multiple people, and that you're generating momentum, because what you're selling is an opportunity to invest in this company that is growing, right? Except for very early, like, what is it, inception stage investments, you need to have an answer to this.
And just to say, depending on the kind of business you're talking about, quite honestly, this will vary. For example, if you're doing biotech or even pharmaceutical, something like that, this is going to look very different, because in the end, you're not going to be generating revenue for a long time to come. And so you'll look at and talking about really more runway as it relates to the next major stage of the process, or to get to, let's call it FDA trials or something like that, or whatever. So there's not always a single way to answer this for every type of business. If you're working in a tech business that's kind of, let's call it the more typical Silicon Valley type business in general, then I think the answers that we're giving are, ultimately going to apply. In some cases, I will also say is that some businesses are able to generate revenue quite quickly, because you can get in market with an MVP and start generating some cash. But the answers for things like that, maybe we can generate cash and we could continue to grow this way for years, but we want to grow faster and we see the opportunity to grow faster, and that's why we're getting the investment money, that kind of thing. So again, some of these things will depend on the type of business, but in general, you need to have an answer for this kind of question, regardless of what type of business you're in.
And we're getting some questions about what stage and when you raise and how much you raise. So these things change, the guidelines change, but there are guidelines that determine whether you're going out for pre-seed, seed stage, Series A, etc. Pre-seed is often MVP stage, early revenue or pre-revenue. It can be raising up to 2 million. You can be raising anything from 250,000 to 2 million. Seed stage is now the milestone that many people are trying to hit at seed stage is $1 million in ARR. And that's, again, that's changing all the time. So I know it's like, oh my God, that's a lot. Yeah, it's a lot. That's not how seed stage used to be. And generally seed stage, you're raising over 3 million. Series A milestone for ARR tends to be about 3 million in ARR plus at this point. So this is very dynamic, but I'm giving you the standards right now that I'm seeing out in the market.
And just the other thing to say is, how long should your runway be? I mean, Helena had said, 6 months. That also can depend on how what we're seeing, what you're seeing in the market currently. So when we're advising companies around when they're raising, how much runway should they be raising to cover? What we are saying is because the raise cycles have gone from, let's say back in 21, when people were just throwing, investors were throwing money at startups and things like that, that kind of thing. It was about 6 months basically was the average. Now the average has gone, even a pre-seed, from 6 to maybe 9 and even 12 months. Now there are things we believe you can do to kind of get yourself in the shorter end, towards the shorter end of that. But let's just say cycles have elongated because investors have become more risk averse, and they are more requiring of seeing more traction than they were in the past, basically. And so what we're doing, like I said, when we advise startups, we're basically saying, ideally you want to raise sufficient so that you will have, once you get the money in, between 18 and 24 months of runway. That's the ideal. Now, you may not get there, but that's the ideal, and we're going to that's how we sort of determine what your raise target ultimately needs to be, netting out any revenue that you might be generating in the meantime, ultimately to offset some of that, because the goal is not to raise as much as you possibly can. The goal is to raise sufficient amount to give you a long enough runway to get to that next milestone, like from pre-seed to seed. Like Helena said, if you're at 0 revenue now, what's it going to take me to get me to the 1 million ARR, essentially, so that then I'm in a good position to be able to go and raise my next seed round if I choose to do that. All right.
So we have a lot of questions and we're getting a little bogged down in the Q&A, and I want to make sure that we get a chance for you all to practice.
Yeah.
Because that's why we're here, to get value out of this. So let's jump into that part of our presentation, if that's okay.
All right, let's do this. We were going to do this other one is, this is another scary one for many, especially at the very early stages if you're solo founders, but we'll come back to it. We'll come back to it later. Yeah. You can choose to practice this one if you want to, especially if you are getting this question, for those of you at the very early stage who may be solo for the time being. And that's, a lot of founders are solo, at least to start. All right. So, all right, here we go. Okay, your turn. We are going to, and we know we've got about 12 minutes left. So we're going to give you a couple minutes only to pick one of these questions. What is your beachhead? How long is your runway? Or do you have a technical co-founder? Pick the one, maybe the one that scares you the most, or the one that you have gotten the most that you feel like, I could do better. Apply the ABC, write it down, and then we're going to ask a few people who are brave and don't mind getting up in front of everybody else, and it will be a gift, let me say, to the group. And we'll be the investor, you'll be the founder, and then everybody will help give you some feedback and things like that and see how it goes. All right, so 2 minutes to do this. Think about your answers and your questions starting now.
Two minutes always seems so long in silence.
We can go off screen, so we doesn't even phase us anymore, but all right.
Raise your hand when you want to practice and you're ready. Leah's ready.
All right. Let's give everybody else another 20 seconds or so. All right. I hope everybody is more or less ready with their answers. And don't worry, if it's not perfect. It rarely is. So just dive in. That's what startups and founding startups is all about. Just dive in. Okay. Lydia, it sounded like you were the first one to raise your hand.
Yeah. I will always raise my hand when I have a chance to get feedback and
All right.
learn.
Awesome. Which
Great.
question are you going with? And well, first
I'm
tell us
gonna
what your
go-
elevator pitch is.
Yeah. Tell us about your business quickly and then go into the question.
Beachhead. Keithley is bridging the gap between discharge and your Davenport. It's door to Davenport care for ambulatory outpatients who've had sedation or anesthesia and don't have a responsible adult to get them from discharge home and settled. This is currently costing ASCs, ambulatory surgery centers, HOPDs, more than $50 billion a year in lost revenue and unrecovered costs. So our beachhead actually are orthopedic ambulatory surgery centers. The new rules that were released January 1st made 271 additional operations, formerly inpatient, outpatient. Orthopedics are overwhelmed. They also have the highest cancellation rate. That means an ASC can lose more than $1 million a year. Even when people reschedule, and that's only at a 33% rate, they're incurring double costs for the same revenue. So that's what Keithley is doing.
All right. So any feedback on that, right off the bat? Obviously, it's a little tricky because, of course, we don't have much time to really even give you the time to do like a, minute and a half pitch so that we really understand about your business. But so I guess for me, the first, I think, and thank you for being the first. So it's awesome to want to get feedback because that is tough to do, to agree to be the first guinea pig.
I've been wanting to get in front of Helena for the longest time, so I'm so excited.
All right, very good, very good. So if
I'm not hard. My book, you can book me online. Come on.
Yeah. So I think some of the feedback I would give is it's always good, I think, in some ways to give your investors who you have to assume, even if you think that they're expert, don't assume that. They can tell you, no, I get all this terminology and then move on. But I would say you start from the default position that you want to speak to an investor just like they're a regular person who may not know the ins and outs of the industry that you're in, for starters. So try to, like I would say, remove some of the jargon, or at least if you're going to use it, explain it. That's number one. Number two is I would say you want to give people, I almost call it like breadcrumbs to say, here's how the market works. It's this, there's this player, there's this player. The biggest source of revenue is this, the biggest detractor of revenue is this. That's why we're choosing this as our beachhead, because it's the, whatever. So you need to do a little bit of explaining and almost like setting up the scene, if you will. And then you dive in, which then says, and that's why strategically we're choosing this as our beachhead. Because usually the idea of a beachhead is, it is either the wedge that gets you to the rest of the market, or it's a narrow place to begin that allows you to test out your, XYZ hypotheses or something like that. There's reasons why you choose certain beachheads. And so, using one of those, figure out which one is right for you. And then once you've explained and kind of set the scene, then you dive in with, and that's why we're choosing it, because it does fill in the blank following thing for us strategically that will allow us to, test out our product or figure out what customers most care about, or, any other feedback for Lydia.
I thought it was very helpful that you mentioned the numbers pretty quickly, because I was like, is it big enough, right? The question you get all the time, is it big enough? And you drop those numbers and that like, oh, okay, there's a reason to keep listening. And literally that was like, yeah, all right, there's a reason. So I thought you did that very well. Lisa, I'd love to get one more person on because we're running out of time.
Yeah.
A little
Thank
bit.
you.
And Lydia, I think you did a good job. I'm sorry that we're a bit rushed. I'd love to spend more time on each person. But Lauren has raised her hand. I'd love for her to.
All right.
Great. Thank you for choosing me for the opportunity. Should I briefly describe the product or just jump into the question?
Just quick elevator pitch, like your 30-second version, and then dive into which question and then give your answer.
Okay, great. So I'll do the do you have a technical co-founder question, because even at my very early stages, I get that all the time. So hi, everybody. I'm Lauren. I'm building a civic tech app called Daily Acts of Democracy. So it gamifies your media content to connect the issues that you already care about and want to take action on to democracy. And then it rewards you for your pro-social behavior. So it's a B2B2C model, and it turns your actions into a points to reward system so that you can vote with your values. So you can win and earn products, services, and experiences that are in alignment with your values. So that's the product. The question again, do you have a technical co-founder? So thank you for your question. So in just a few months of development, I've already built an MVP, which you saw, and I've conducted over 300 demos, and I'm building my first advisory board to prepare for my seed round. So that advisory board includes a host of technical experts coming from experience in government and private sector and consumer goods. So I'm definitely open to partnering with a technical co-founder who shares my values and passion for civic engagement and democracy, and can really complement my strengths in social impact and media and tech for public engagement.
All right.
That's what I've got.
Yeah, I think it's pretty good. I have to say, I think it's pretty good.
Yeah.
And I think your elevator pitch, which you've clearly had to do a couple times, was also very good, very crisp to the point. I liked it. It was made sense to me anyway, in a short time. So that's pretty awesome.
Thank you.
Only here actually, since we were going to do this, and it sounds like what you're saying is you don't have a technical co-founder yet. That's basically where you are, right?
That's where I am, where it's like, if the right person comes along, I'm
Yeah.
open to it, but it's not preventing me from moving forward.
That's the point. That is exactly what you're conveying, which I loved. Yes.
Yeah. So I think a way to sort of like actually take what you're already saying and frankly strengthen it is actually to turn this, like it's okay and I'm open to, no, I've made the decision very specifically to be exactly where I am right now. And so you could say something like, you know what? Good question. Not yet, but I'm actually super comfortable with that at this stage. My job is to make sure we're solving the right customer problem. I've actually often found that when people bring on technical co-founders too early, before they've really nailed the customer problem and the solution, oftentimes it can lead to things being slow, wasted money, things like that. So I can obviously hire for execution, and I will, but finding the right long-term technical partner, which I will, is really about long-term alignment. And I'm being very deliberate about that right now while we answer the fundamental question, which is, are we answering the customer problem? And I want to build that and test the product out, which is the priority at this stage. That's the kind of thing, which is taking the I'm open to, no, it's not that you're not open, but you're saying like, I have specifically decided to do it exactly this way. And this is why I think that is in fact a strength and not something which is a weakness. Because frankly, again, a lot of women in particular, honestly, even women engineers, believe it or not, will constantly get this question. Like, do you have a technical co-founder? And you're like, yeah, that's me, that kind of thing. When more often than not, you're not that. This comes up all the time. And so, but taking what you did and just slightly strengthening it to say, this was my strategic decision to do it this way is, I think, great.
Okay, great. Thank you.
We're a little short on time, so I'm asking Liesl to jump forward to our quick pitch, and then we can keep going with Q&A or coaching on this in any way that you want to. But we are taking next week to focus on this practice.
Here we go.
And what we find with our current clients is this is invaluable. We have taken a week a month with our current clients to do this every month with them, because the practice is so key. And what you want is to really be light on your feet, ready to answer all of these questions. And there's a lot of them. We're going to send you a glossary and sample answers as a guide. So sorry, that's for our program. So we are doing this next week. We're meeting 2 hours a week. Sorry, 2 hours a day, Monday through Friday, at 1 p.m., same time that we're doing right now. And we're going to be practicing this. We're going to practice the pitch. We're going to practice promotion questions and answers, and we're going to focus mostly on the prevention and how to turn those into promotion answers. Daily Zoom sessions, same time, same place. And when you leave that, you'll come away with a glossary of prevention and promotion questions, along with sample answers to use as a guide. The price for that is $4.99. We have a sign up link here. If you have found this to be valuable, we'd love to know. We'd love your feedback. We're going to be sending a form after this. And here's a sign up link on this page and on the next page to sign up for next week if you're interested.
Let me just put it up there. So there we go. Okay.
Yep.
All right.
And then with that being said, we're open. That's taken off our plate. We're open to any Q&A, any practice, more practice.
Yeah, for those of you who have to jump, you know, obviously we understand that, and thank you so much for coming today. But if you want to stick around, we're going to be open to answer questions if anybody has any.
I want to hear Zach's answer to a technical co-founder, because he said this used to trip him up all the time.
All right, come on, Zach.
Oh yeah, I had a lot of, so I was solo for a while, and I had a lot of people like, no, we won't even talk to you if you're solo, just go away. And I was like, well, I can't really do anything about that. I'm trying. And I went through all of these co-founder, issues, and now I've got a team. And so my answer to that, and this is also a weakness, is I tend to not share about my experience. So I've got over 12 years of experience developing and designing products and design systems at scale. And that almost never comes up.
Yep.
And so then I get the technical questions. It's like, no, I'm that. So that definitely is resonating. And then the other part of the answer is that I'm supported by a great founding team with experience in go-to-market and sales at specifically my industry, and for products that have launched in market. And then we've got an industrial designer and mechanical designer for consumer goods, which is what we're developing as well. So we've got we've got our bases covered with the team.
Yeah.
And then we have deeply experienced and relevant group of advisors as well.
Yeah. You know, one thing I will say is I do think advisors are important, but I'm going to say that I think from an investor standpoint, especially VCs, the ones that are professional that essentially listen to thousands of these things, like every whole year long, which is why they can come across as kind of jerky sometimes. If you have an advisor that, whether it's a name somebody recognizes or that has very, very key experience, like deep industry connections or something like that, mention. If it's just generally advisors, that sort of, it can feel weak in some ways to say it. It's not that it is, because actually advisors can be super helpful. So that's how I sort of determine whether you talk about advisors. And I think the things, Zach, that you said the first is that you do have relevant experience. And so you can lean into, yeah, I've been developing products, and design systems for blah, blah, blah years, that kind of thing. So that already says I understand the technical development process. The second thing is, like you're talking about your strong team. That's another thing. Lean into a team. If you guys have a team, not everybody has one yet, but if you have one and they're experienced, lean into that. And then do the same thing we talked with Lauren, which is you could say that, that this is exactly where I had planned for us to be at this time. We're doing this, we're doing this. Of course, as we build out our team and I build out the leadership structure over the course of time, yes, that will be a place where I'm looking for the right leader. But as you know, this is a long-term partnership. It's critically important that we get the right leader. And so we're not going to jump in to do that too early. We're going to do X, Y, Z. So it sounds like it's all part of your plan. You have enough of good experience. And frankly, to be honest with you, I was just looking at some stats yesterday, is that the solo thing, like you said, again, it's part of the YC playbook. Absolutely, OMG, is it part of the YC playbook, which is, you never invest in solo founders, it never works out. And I got that too, because in the end, I was a solo founder. By the way, having had several missteps and false starts with people that I tried to bring on as co-founders and that I was using the wrong selection criteria. And so it didn't work out. And that was
Yeah,
very
exactly.
distracting and very expensive.
Exactly.
So I totally believe in what I said about you want to take your time. If there's not somebody naturally who sort of comes out of your network or whatever, you don't want to jump just because YC says you got to have a, co-founding team.
Well, and I'm from the West Coast. I'm from San Francisco, and so that was kind of in my mind, like, oh, we're going to be technical. And I've actually flipped our team to be more geared towards sales and marketing, and we're getting customers to sign up.
Yeah.
And we don't even have our hardware product built yet. They don't need
That's
visuals.
brilliant.
They don't need to see anything. So
Yeah.
our messaging is really resonating, and we're getting signups from that.
I love
And
it.
I want to be oversubscribed. And so that's kind of helping me get around the well, you don't have a guy, you need a guy on your team that's from MIT. Like, I've gotten that feedback. Like, where's your MIT engineer that's part of your team? We don't need that. We're getting customers already, and that's what matters. And by the way, one of our advisors was VP of marketing at this industry specific organization. And so, like, we're focusing on that first, making sure that we have sales and oversubscribe. And I can go and get a contractor to do this work that's gonna knock it out of the park. And we already have them on. We already have everything invoiced to pay for that. So
it's all about, these questions are all, and these points are all about removing risk, right? And reassuring investors that you're the one to invest in. And so what you're saying, Zach, is perfect. Like, if you can get people to sign up, like, sales and distribution is becoming such a huge differentiator because tech is becoming easier to do.
Yes.
And we're seeing all these tools, all these things happen, but people actually getting on the platform or on the solution is the most important thing. And so it's not just one item. There's just it's kind of a combination of items. So when people are saying you need a fractional CTO or you need a CTO on your leadership team, or you don't need, like, it's the entire bundle that you're presenting, which needs to be de-risking it enough. So traction will change that, your network can change that, your background can change that, etc.
Yeah.
I'm talking to everybody, not just Zach. But so, solo foundership is changing because of AI, but it is still seen as risky.
The one thing I have to say, Zach, is honestly, like right now, even compared to just 5 years ago, because this question, again, in the pre sort of Gen AI, version of the world, maybe you still did need a technical somebody that you're paying or something else in order to build your product. As we know, that is not the case. That is not the case anymore to get to MVP and to get a product to market. And so in the end, the harder thing, I'll be on to me, unless it's like, let's call it deep, deep tech, in which case maybe you need the MIT, whatever. But for the most part, the key thing is sales and marketing. Can you get people? Have you built something people want to buy? And if they do, and they are showing it by buying it and signing up, that is money, like literally in every sense of the word, that kind of thing. And so traction is king at this point. And if that's what you're saying, that is exactly what you lean into, which is, yes, you acknowledge as a technical thing, and eventually, you're totally comfortable. This is what you need right now. But let me tell you about how great we're doing so far. And that's the thing that people are going to remember. And that's the impression you want to leave, because that's one of your strongest legs to stand on.
Yeah, Zach says he can get signups from a one sentence cold DM. That's great. Now, can you keep them there? Right?
Yeah.
But this is excellent. Do we have any more questions?
All right.
No?
Well, it's been a real pleasure. If you like what you saw today and you think, gosh, I could really benefit from, essentially 10 hours of this, next week, where we will share both promotion and prevention. We will go through, you'll have multiple opportunities to practice and get feedback from the group and be in that sort of slightly pressure type situation where you have to kind of perform, because really fundraising is performance art as much as anything else. And then, we'll obviously give you the materials that we really are the only ones that have ever developed, which is everything just from the glossary of questions, for heaven's sakes, but to taking these frameworks and giving you sample answers that then you can take and then apply, as you just did today, to your business and try it out and see, what does the audience think? Was it convincing? Was it meh? Was it weak? Like, you get to do it with us before you have to do it with real investors.
In a safe space. And so, if some of these questions are really triggering, you get to desensitize yourself and get ready to answer them.
All right. So we'll look forward, hopefully, to seeing some of you next week.
We've had a question, Liesl, can we do it another time, another week, so that's something that we need to consider and come back to the people that were here, because I know that at least 3 people said that they can't make it next week.
Yeah, if next week is not going to work for you, then make sure, again, maybe Helena, you've already got the people, get who
I do, yeah.
That. We'll get back to you, because we do, as I say, we do this on a regular basis with the clients that we work with anyway, because we do other, kind of more longer term consulting assignments and engagements with founders over a period of many, many months as they get ready and do their raises. But yes, so we will be doing it, and depending on how many people there are, we may decide to do another version of this or something in another couple of weeks or whatever. But let's see that from the people, from how many people say, yeah, I'd love to do it, but I just can't do it next week.
Cool. Excellent. Thank you so much. We are sending out a feedback form, and we'd love for you to hear what you really think about our presentation today. Okay?
All right. Thanks, everybody.
Awesome. Thank you.
Bye.
All right, bye. I'm going to stop the live stream. So we are not live streaming. The live stream to LinkedIn did not work.
Of course.
Yeah. I'm kicking everybody out. Hold on. It just didn't work.
Okay. All right.
We've got all these note takers in here, so let me just get rid of them.
Yeah.
So many note takers. And note takers don't leave.
I know. It's funny. Yeah, kick them all out. And then I guess
Kitty,
why don't
you and me.
we can stop the recording, and then
Yeah.
maybe you and I jump on real quick or that kind of thing right after. How about that?
Do you want us to close and we'll come back? Or you want me to just stop recording?
I'll do. Okay, here, let me do leave. Am I ending the meeting, or is it your meeting?
It's my meeting.
Okay. So why don't you just close it, and then I'll set up another, I'll send you something.